Hey everyone, and welcome. So, you ever hear on the news that the economy grew by 2% and wonder, what does that even mean? How on earth do you measure something as massive and complex as an entire country's economy? Well, today we're going to pull back the curtain and break down the basics of how it's done.
So here's our game plan. We're going to start with a really big question. What actually makes a country wealthy? From there, we'll look at the stuff an economy makes, figure out the right way to count it all, see how money and goods move in a big loop, and then finally, we'll put all the pieces together to define that big one you always hear about, GDP.
All right, let's jump right into that first question. What does it mean for a country to be rich? The answer might surprise you.
I mean, this is one of the oldest questions in economics. Adam Smith himself was obsessed with it. Is it about having a ton of gold, or maybe endless reserves of oil? What's the secret sauce? Well, it turns out it's not really about having a big pile of stuff. Having natural resources, or what economists call a stock, is great, but it's not the whole story. Real economic strength comes from a country's flow, its ability to consistently produce new goods and services year after year. Think about it. Some countries are sitting on tons of resources but are still quite poor. It's not about what you have, it's about what you can do.
Okay, so if this flow of production is what really matters, then the next logical question is, what's actually in the flow? What kind of stuff are we talking about?
Let's trace the life of something simple, like a t-shirt. It all starts with a farmer growing some cotton. That cotton is what we call an intermediate good. It's just one step in a longer process. The mill buys it and makes yarn, another intermediate good. Then that yarn gets woven into cloth, still an intermediate good. Finally, a factory takes the cloth and makes a shirt. That is the final product.
And this brings us to a super important definition. A final good is just what it sounds like. It's reached the end of the line. It's not going to be transformed into something else. It's ready to be bought and used by the final customer. Getting this distinction right is absolutely crucial for measuring an economy.
Now, these final goods really come in two main flavors. First, you've got your consumption goods. This is the stuff we all buy and use up, like groceries, a new pair of shoes, or a ticket to a concert. But then you have capital goods. These are also final goods, but instead of using them up, we use them to make other stuff. We're talking about things like a tractor for a farm or a big piece of machinery in a factory. They are the tools of the economy.
Of course, those capital goods, that tractor or factory machine, they don't last forever, right? They get old, they break down, they wear out. This process is called depreciation. You can kind of think of it as a little piece of the machine getting used up every year. And it's really important to account for this to get a true picture of a country's economic health.
All right, now that we've got the difference between intermediate and final goods, we can talk about the single biggest mistake people make when they try to measure an economy. It's such a common problem, it even has its own name, double counting. Let's imagine a super simple economy. There's a farmer who grows wheat and a baker who makes bread. Let's say the farmer produces 100 rupees worth of wheat. The baker then buys 50 rupees of that wheat and turns it into 200 rupees worth of delicious bread. So here's the question. To get the total size of this little economy, do you just add the farmer's 100 to the baker's 200 and get 300? Seems logical, right?
No way! If you do that, you've fallen right into the double counting trap. Think about it. That 50 rupees worth of wheat is already baked inside the price of the 200 rupee bread. So if you add 100 and 200, you're counting that wheat once when the farmer grew it, and then a second time as part of the bread.
So how do we fix this? Economists came up with a really clever idea called value added. It's simple, really. For any business, you just take the total value of what they sold and subtract the cost of all the materials they bought from other companies to make their product. Now let's see how this solves our problem. For the farmer, he didn't buy any intermediate goods, so his value added is the full 100 rupees. For the baker, her value added is her 200 rupee output minus the 50 rupees she spent on wheat, so that's 150. And now, when you add the value added from both of them, 100 plus 150, you get 250. That is the true value created in this economy. No double counting.
Okay, so this value-added idea works great for a couple of businesses, but how do we scale this up to an entire nation? Well, that's where we need to look at the big picture, the economy's circular flow.
Now this chart looks a bit busy, but the core idea is incredibly simple. The economy is basically one big loop. You have households, that's us, and we provide our labor to firms. In return, the firms pay us income. Then what do? We take that income and spend it on the goods and services that the firms produce. See? It's a circle. Money flows one way, and goods and services flow the other.
And the really cool thing about this loop is that it gives us 3 different ways to measure the exact same thing. We could add up all the spending that happens. Or we could use our new trick and add up the value added from all the production. Or we could just add up all the income that everyone earned. And here's the kicker. In theory, all 3 methods should give you the exact same number.
Okay, we've laid all the groundwork. We have all the pieces of the puzzle. It's time to put it all together and finally talk about the big one, gross domestic product.
And here it is. This is the big definition. GDP is the total market value of all the final goods and services produced inside a country in a given year. But look at that first sentence. It's the sum of the gross value added of all firms. That's right. The whole concept we just figured out with the farmer and the baker is literally the foundation of how we calculate GDP.
So it all boils down to this simple, powerful formula. GDP is just the sum, that's what that E-looking symbol means, of the gross value added from every single producer in the economy. You add up the GVA from the corner coffee shop to the biggest car factory to the tech giants, all of it, and that's your GDP.
So there you have it. We've gone from asking what makes a country rich all the way to the formula for GDP. We now know how to measure the size of an economy. But that brings up a much bigger, more philosophical question, doesn't it? Does a bigger number for GDP automatically mean that people are happier, healthier, or better off? That is a much tougher question, and a great topic for another time.